Hello students, welcome back to the brief description of week 2 content during our regular classes. In day 1 I'll be covering problems on trial balance, and also in day 2 also I'll be covering problems on trial balance, and in day 3 I'll be moving on to preparation of final accounts of companies in vertical form as per Companies Act of 2013. That is, I will be explaining the income statement and headings under income statement, and in day 4 preparation of final accounts of companies, I will be explaining balance sheet, its headings under the balance sheet, and in day 5 I will be solving problems on final accounts. So as all of us know, the process of accounting starts with making journal entries, then posting entries made in journal into ledger, then entering the balances of ledger, that is the credit and debit balances of ledger in trial balance, and trying to get the balance of trial balance. And the last step in accounting process is preparation of final accounts, which is very important for any organization for decision making. So as decision making is an important role of any manager, it's very important for a manager to prepare the final accounts, the annual report, the report prepared by the management of the company to its owners, informing them about the performance of company over the preceding financial year is the big challenge. So I'll be explaining how to prepare final accounts, that is the income statement and the balance sheet. So income statement, or it is also called as profit and loss account, is one of the imperative component of financial statements. The aim of income statement is to quantify and present the financial performance of the company for a given period. It depicts the total income of the company, disbursement of company for a given period, disbursement incurred in deriving that income, income tax payable for the government, and the net profit earned, the dividend paid to shareholders, and the profit retained in the organization. Also will be depicting about the uh, earnings that is flowed back in the company. It summarizes the activities of an enterprise in a period by disclosing the revenues earned and the expenses incurred by measuring the net profit earned by business. It indicates its degree of operating success. So income statement has some features. It has been prepared for 1 year, that is during the year end, and it covers the effects of all financial operations of the year, and comparative position of each account of the income statement on a particular period also will be disclosed. It helps the reader to understand the changes in the income, expenses, tax, profit and dividend over the previous year. Income statement is drawn vertically. Earlier it was prepared 3 accounts separate, like trading account, profit and loss account, and profit and loss appropriation account. But now only one account is prepared, which is called as income statement or profit and loss account, that depicts income, expenditure, earnings before tax, earnings after tax, and other appropriation at one place. The objectives of preparing income statement is to know the results within given accounting period, to know the operating efficiency of the company, to know the progress of the company as compared to its previous year, to forecast its future prospects. So these are the main objectives of preparing income statement. And income statement will follow some accounting concepts like accounting period concept, accrual concept, realization concept, and matching concept. According to going concern concept, business will be likely to continue for an identifying long period of time, and as such the financial results of the business operations can be ascertained only after the liquidation of the business. But the ascertainment of financial results only after liquidation will not serve the purpose of any business. Uh, that is where it was felt that there is a need to determine the profit or loss at regular intervals of time. The accountants generally choose some convenient slice of time, which is generally 1 year, for determining the amount of profit or loss, and this time is known as accounting period. The length of the accounting period depends on the nature of business and also objective of the proprietor of the business. In India, accounting period is for 12 months starting from 1st April to 31st March of the subsequent year. It is also fiscal year or the financial year of the government. So realization concept in income statement is revenue is recognized or is considered as being earned on the date on which it is realized. It is considered as being realized not when goods are produced or order is received or contract is signed, but on the date on which goods or services are transferred to the customer and the customer becomes legally liable to pay for them. The accrual concept suggests that when a transaction has been entered into, its consequences will certainly follow. So, all transactions must be brought into record whether they are settled in cash or not. It suggests that an accountant is required to treat as revenues all those items for which there are the legal right to receive, although cash might not have been received for them. Which means if revenue is earned but payment is not received, the same should be recorded as revenue. Similarly, an accountant is required to treat as expenses all those items for which there is the obligation to pay, although cash might not have been paid for them, which means it is if an expense is incurred but no payments is made, the same should be recorded as expense in the books of accounts. Then the implication of matching concept in income statement is that all the revenue items and relevant expenses should be correlated and matched so that a clear picture of profit or loss is available. All revenues earned during an accounting period, whether received or not, and all expenses incurred, whether paid or not, must be taken into consideration when preparing income statement for the period. Similarly, all amounts received or paid during the current period but pertaining to either next year or previous year should not be considered in computing profit and loss account of the current period. So, preparation of profit and loss account or income statement will follow these four concepts of accounting, and actually I will be providing you the pro forma during the classes to prepare the income statement, and there are few items that should be understood in the income statement like operating expenses, administrative expenses, selling and distribution expenses, depreciation, amortization, non-operating income, non-operating expenses and losses, where operating expenses are those which are the expenses other than cost of goods sold, interest and interest income tax, which are incurred in the running or the normal course of business. These expenses are often grouped into some categories such as selling and general and administrative expenses. So, some examples of administrative expenses are salary, rent, rates and taxes, printing and stationery, postage, telegrams, telephone, repairs and maintenance, insurance, audit fees, legal charges, bank charges, etc. They all are some examples of administrative expenses. Examples of selling and distribution expenses are commission paid, freight, carriages and sales tax, advertisement, trade expenses, traveling expenses, showroom rent, entertainment expenses, a commission to salespersons, reserve for discount on debtors, bad debts, etc. are some of the examples of selling and distribution expenses. And depreciation and amortization means value of fixed assets that keeps on reducing over their useful life due to the usage and also due to wear and tear. This reduction, known as depreciation, and is charged to income statement. Any company, as and when they buy fixed assets, they keep some of the profit aside to replace existing fixed assets when the life of the asset gets expired. Depreciation is charged to tangible assets and amortization is charged to intangible assets like copyright, trademark, patents, etc. And coming to non-operating income, non-operating incomes are the income that are earned without the help of the day-to-day operations in the business. Examples are interest earned, interest on drawings, income received from investment, interest on fixed deposits, rent received, profit on sale of assets. These are all some of the examples of non-operating income that has to be considered while preparing income statement. Non-operating expenses and losses are those which are incurred without reasons of the day-to-day operations. Some examples are interest paid, loss on sale of fixed assets, interest on capital, and loss by fire, discount allowed, etc. are some examples of non-operating expenses. Also, we have to note that discount received is considered under other operating income because it is income earned from operation of the business, and discount allowed is considered under non-operating expenses and losses because it is the expense which is incurred for managing and supply sources of the finance that is necessary for the firm. So while preparing the income statement, these things have to be kept in mind. And uh, so we arrive after considering operating expenses and incomes and non-operating expenses and income, we will be arriving at interest earnings before interest and tax. From that we have to deduct interest, we will get earnings before tax, then we have to deduct the tax percentage that is being provided during the year, we will get profit after tax, and also we have to add the previous year's balance of profit and loss account or the undistributed profit of the previous year, so that we will get profit available for appropriations, and we have to deduct the appropriations, we will get the total of appropriations and also the balance carried forward. So this is how we will prepare the income statement. So once income statement is prepared according to the Companies Act, actually this we will be preparing according to the Companies Act, then we will start preparing the balance sheet. So we know that balance sheet is also one of the vital constituents of financial statements. The objective of preparation of balance sheet is to gauge the financial position of the company on a given date. The balance sheet is enormously helpful in studying uh, the enormity of the economic resources. It depicts the asset composition of a company and how it has been financed. Balance sheet also provide the very essential information that management has been able to efficiently manage the assets and liabilities of the company. The balance sheet presents an enterprise assets, liabilities and equity. At a point in time, it summarizes the resources of the claims to those resources by owners and creditors of the enterprise on a certain date. So, balance sheet has some features like it has been prepared as at or as on a particular date and not for the entire year. The comparative position of each account of balance sheet on a particular date will also be disclosed, uh, which helps any person to understand the changes in financial position, and it is prepared vertically according to the Companies Act. For any corporate, the balance sheet will also depict the sources of fund, application of fund, and net working capital employed in the business. So, what are the objectives of preparing balance sheet? So, balance sheet is prepared to measure and present the financial position of the company on a given date, and it depicts to depict the asset structure of a company and how this asset structure has been financed. To know how the asset structure has been financed, we will prepare the balance sheet. Also to understand what are the sources of funds and the application of funds, and to act as an effective communication tool for the stakeholders, like any that is, the government would be interested in knowing the positions of assets and liabilities, or the shareholders would be knowing would be eagerly uh, waiting to know the assets and liabilities positions, or the public or any person who is interested or who is involved in the business will be eagerly waiting to know the assets and liabilities position of the company, and hence we prepare the balance sheet. And there is also one more term called as marshalling of balance sheet, which means that the order in which the various assets and liabilities are shown in the balance sheet, that is what is called as marshalling of balance sheet. And this is done in two ways, in the order of performance and also in the order of liquidity. Usually companies will follow the preparation of balance sheet in the order of performance, but the sole proprietorship concerns, partnership concerns, banks, etc. will follow the order of liquidity. So, now coming to the importance of balance sheet, that is, what are the accounting concepts that are incorporated while preparing the balance sheet? Monetary unit concept or money measurement concept is incorporated, business entity concept is incorporated, going concern concept is incorporated, cost concept and accounting equation concepts are incorporated while preparing the balance sheet. So, how this money measurement concept is incorporated? Money measurement concept means a record is made only of those transactions or events which can be expressed in terms of money. Any event or transactions which cannot be expressed in terms of money will not be recorded in accounts, like teamwork, employee dedication, loyalty, health of employees, etc. Though they are vital events, as they cannot be measured and expressed in terms of money, they are considered as non-monetary events, and hence they are not recorded in the books of accounts. This concept is called as common denominator concept, because this concept helps the concern to express items of diverse nature like furniture, machinery, bank balances, building, etc. in terms of a common denominator. However, this concept has one serious drawback, which only monetary transactions are recorded in account books and no recorded is kept of non-monetary events. So, this is also one of the important aspects that should be incorporated while preparing balance sheets. And business entity concept, in every business organization, whether it is a sole trading concern or a partnership or a joint stock company, is considered as a distinct entity from the persons who have started it or who owns it, as the business of the proprietors who own the business are regarded as two separate entities. The transactions of the business are distinguished from those of the proprietors, and in the books of business, accounts are kept only for the transactions of the business and not for those of the proprietor. So, going concern concept, according to this concept, it is assumed that the business will continue to operate for an indefinite long period in the future. That is, concern that will continue to operate for a fairly long time unless there is good evidence to the contrary. This concept makes a distinction between revenue expenditure and capital expenditure possible and meaningful. And this concept provides a sound basis for proper measurement of profit. In the absence of this assumption, an accountant will be compelled to determine the current value of assets and liabilities every time he prepares the financial statements. According to cost concept, an asset acquired by a concern is recorded in the books of accounts at cost, that is, at the price actually paid for acquiring the asset. The market price of the asset is ignored, and it is its cost price that forms the basis for the subsequent accounting for that asset. It should be noted that the cost concept is of special significance only for fixed assets. Why? Because it is only the fixed assets that are shown in the balance sheet at cost less depreciation. Any current assets are not affected by this concept. And the accounting equation concept or the dual aspect concept, it is very basic foundation of the universally applicable double entry bookkeeping system. It stems from the fact that every transaction has a twofold effect, and this is called as dual aspect. Every business transaction always results in receiving of some benefit of some value and giving of some other benefit of the equal value. Say for example, when business purchase goods for cash, it receives goods from of some value and pays cash of that for the goods for that of the equal value. Similarly, when it sells goods for cash, it receives cash of some value and gives goods of equal value. So thus every business transaction involves dual or double aspects of equal value, and hence in accounting a record is made of the dual or two aspect of each transactions based on the accounting equations. That is, as per the accounting equations, total assets is equal to owner's capital plus the liabilities. So, and also we should keep in mind few points while preparing the balance sheet, like sources of funds, that is shareholders funds, that is the funds that are contributed by the owners and the shareholders, and they include the accumulated retained earnings and the other reserves of the company. And this fund will represent as the share capital and reserves and surplus in the balance sheet. And the share capital will include equity share capital, preference share capital, and reserves and surplus. So what is this reserves and surplus? It is that portion of earnings and receipts, that is both capital and revenue of the company, which are set apart by the management for a general or a specific purpose. A reserve would generally include capital reserve, capital redemption reserve, share premium, or other reserves like debenture redemption reserve, revaluation reserve, general reserve, and sinking fund reserve. There are so many types of reserves that the company can create, and it can be some portion of the profit can be credited to that reserves. And surplus means it represents the credit balance of profit and loss account retained in the business after providing for the proposed appropriation towards dividends and the reserves. And loans and funds, that is the long term loans and funds, are those funds that are borrowed by a company which are secured as well as unsecured. That is, secured loans, they are availed by the company against the security of one or more assets of the company, like term loans from financial institutions, debentures, working capital loans, etc. And unsecured loans are they are not backed by any kind of security, that is in the form of assets of the company. Some of the examples are fixed deposits, loans and advances from the holding or subsidiary companies, unsecured debentures, security deposits from suppliers, short term loans and advances that are repayable within 1 year of the balance sheet. So these are the long term funds both secured and unsecured, that has to be recorded in the balance sheet. And these are some of the items under balance sheet. And coming to the application of funds, that is whatever the funds that you have sourced, what you have bought from that, how you have applied those funds in the normal course of business for earning profits. Some of the examples of funds applications are fixed assets, investments, current assets, loans and advances, current liabilities and provisions. So fixed assets will represent assets held with the intention of being used for the purpose of producing or providing goods or services and are not held for sale in the normal course of business. Fixed assets mainly can be tangible assets like land, building, plant, machinery, vehicles, furniture, fixtures and equipments, and intangibles like goodwill, copyright, trademarks, patents, etc. And the capital work in progress, which refers to fixed assets under construction or installation. Then the next item under application of funds is investments, which represents assets that is held for earning income by way of dividend, interest and rentals, capital appreciation and other benefits. That is in simple investment, in simple term, investment refers to deployment of surplus funds for earning income, commonly known as non-operating income. Some of the examples are company may diversify into other lines of business through investments in associate companies, joint ventures, subsidiary companies, etc. Now this other part in the balance sheet under asset side, where the sourced fund is deployed, is current assets, loans and advances. Current assets are those assets which held for consumption or for sale and are expected to be realized in cash during the normal operating cycle. Examples of current assets are inventory, sundry debtors, cash, bank balances, etc. Loans and advances are also current assets, which include assets that are held for short term and expected to be realized within 12 months. Examples: to make advance payments of expenses, pay to the suppliers in advance, provide loans and advances to associates, subsidiary or holding companies, extend advances and loans to employees, provide securities to various government departments like excise, pay advance income tax, etc. All these loans and advances are secured or unsecured. And the current liabilities and provisions are under the liability side of the balance sheet, where the current liabilities means the operating cycle of the business needs current assets, which means demand for funds, but the cycle generates some funds, which is spontaneous credit known as current liabilities as well, and to that extent eases the financial burden of the company. Say example is sundry creditors, expenses payable, advances from customers, unclaimed dividend, etc. And provisions are amounts set aside for any known liability as per statutes requirements, or whose amount requires measurement by using a substantial degree of estimation. Examples of provisions are provision for bad debts, provision for taxation, proposed dividend, provision for depreciation, provision for contingencies, provision for retirement benefits for employees like pension, gratuity funds, leave encashment, etc. And also miscellaneous expenditure which are not written off, uh, where miscellaneous expenditure represents revenue expenditure to the extent not charged to the profit and loss account, and thus deferred over one or more accounting year. Examples are preliminary expenses, public issue expenses, large advertisement campaigns, etc. And also losses are also have to be considered, which means the debit balance in profit and loss account after adjustments against uncommitted reserve if any, and is the last line item of the asset. So we need to know in detail about the balance sheet in order to prepare the balance sheet for the purpose of decision making, for the purpose of use by different stakeholders of the organization for taking decisions whether to invest in the company or not.